Hey everyone, it's Julie here with TipRanks. Today, we're taking a look at whether it's time to buy the dip on two strong buy stocks. So let's get into it. All right, guys, welcome back. Thank you all so much for being here. First off, I wanted to apologize for my absence last week. I did have the opportunity to attend Robinhood's Hood Summit in Vegas for a few days. Had a great time there, met some awesome people, and heard some really exciting updates from them. But we are back to normal life now and back to our normal content. Today, we're taking a look at two stocks that have been trending lately with Wall Street analysts, picking up plenty of recent buy ratings, but the stock has been dipping in price. So today, we're going to take a look at these two companies, what it is that they do, what challenges their stock has been facing, and why analysts are maintaining those buy ratings. We found these stocks on TipRanks Trending Stocks page. Found underneath the Research Tools menu, here you can find stocks over the last 3 days, 7 days, or 30 days that have been gaining a lot of attention from Wall Street analysts. We looked at the best rated and found a couple stocks that were in the red recently. You can check out the trending stocks for yourself right on the TipRanks website or on the mobile app, which you can download using the links in the description down below. If you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Now let's dive right into these two trending strong buy stocks. First up, we're taking a look at Rubrik Incorporated. They trade under the ticker RBRK, currently priced at $74 per share. The stock has gained tremendously in the past year, and year to date is up 13%, but in the last 3 months has fallen 15%. Rubrik is a cloud data management and security company specializing in zero trust security software. They specialize in zero trust data security to protect enterprises against cyber threats like ransomware. They provide a unified platform for data protection, threat analytics, security posture management, and cyber recovery, supporting enterprise, cloud, software as a service, and unstructured data across sectors like finance, healthcare, and government. Rubrik shares have been under pressure due to high expectations and a deceleration in subscription and an ARR. The number of channel partners contributing more than 10% of revenue decreased, indicating a potential risk of over-reliance on fewer partners. They've had some ongoing profitability issues with negative net income and EBIT margins, and that could hinder their ability to sustain operations without external funding. While their stock did decline following their latest earnings report on September 9th, Rubrik did come out with a notable earnings and revenue beat. They reported a loss per share of 3 cents, which was 31 cents better than analysts were anticipating, and revenue climbed to $309.8 million, beating expectations by $27 million. Subscription revenue grew 55% year over year, and they continue to win the cyber resilience market with new customer wins and innovate in cloud protection. And while those results were all positive, it was their future guidance that left investors wanting more. Their Q3 sales guidance of $319 to $320 million and a net loss of 18 to 16 cents per share was insufficient to justify their high valuation, which led to the significant pullback. Despite that disappointing future guidance and the sell-off in shares, we have seen several Wall Street analysts actually increase their price target. That includes a 4-star analyst from CIBC. They boosted their price target to $130, saying that their positive thesis on shares was reaffirmed by the Q2 earnings report despite the conservative Q3 outlook. They're forecasting revenue growth of 34% for fiscal 2026 and find Rubrik shares attractive at current levels. We also heard from a 5-star analyst at Rosenblatt. They said the company posted another solid quarter with sales growth of 51%, and that Rubrik continues to see healthy interest in its cyber resilience platform. They upped their 2026 and 2027 estimates on improving billings and margins. The Rubrik stock has 16 current analyst ratings and comes in as a strong buy based on 14 buys and 2 holds. The average price target of $114 implies an upside potential of 54% from current prices. Looking at those ratings down below, we see a bunch of analysts weighing in following that earnings report, upsides ranging from about 10% upside all the way to 75%. And for our second trending stock that has been dipping in price, we're taking a look at Chewy. They trade under the ticker CHWY, currently priced at $38 per share. In the past year, they're up 15%, but in the last 3 months have fallen about 11%. Chewy is an online retailer specializing in pet supplies and services. They offer a wide range of products like pet food, grooming supplies, treats, medications, etc. for dogs, cats, fish, birds, small pets, reptiles, horses, and more. They have features like auto ship for recurring deliveries and free shipping on orders over $49, and also offer veterinary services, prescription fulfillment, and supports animal welfare initiatives. Shares of Chewy took a hit after they faced higher SG&A costs during their second quarter. Those expenses deleveraged approximately 30 basis points year over year, driven by the ramp of the Houston Fulfillment Center and higher inbound inventory processing costs. Those were primarily within hard goods and were incurred to mitigate tariff impacts and ensure adequate holiday inventory. Now, there were some highlights from the quarter. Earnings were in line with expectations, and they did increase their outlook looking forward. Q2 net sales grew by nearly 9% year over year to $3.1 billion, exceeding the high end of their guidance range. Auto ship customers hit a record of $2.58 billion, and they also saw their gross margin expand to 30.4%. We have seen quite a few analysts slightly lower their price targets on the Chewy stock by $1 to $4, but many of them are reiterating buy ratings, including one from Morgan Stanley. They said that Chewy came in below buy-side expectations on EBITDA for the third consecutive quarter, which raised concerns about margins. But the firm believes the miss was due to a lack of clarity on timing of expenses rather than a structural change. We even had a 5-star analyst from Deutsche Bank upgrade their rating on the stock to a buy. They said the company's growth investments in the second half of 2025 will drive earnings estimates cuts, but buy-side expectations are now in a better place. They believe that if Chewy's investments reinforce their market share position, the company has more levers to drive revenue growth in 2026 and beyond relative to the downside risks. The Chewy stock has 21 current analyst ratings, coming in as a strong buy with 16 buys and 5 holds. The average price target is just above $46 per share for an upside potential of nearly 22%. Looking at those recent ratings down below, again, you can see several analysts slightly lowering their price targets there. Upside's potentials range from just a couple percent all the way up to 41%. So that is a quick look at 2 trending stocks that have both dipped in price recently, but have Wall Street analysts reiterating strong buys. Let me know your thoughts on these 2 companies and whether you'd buy the dip on either. I always appreciate hearing from you guys in the comments down below. Of course, keep in mind these videos are never a suggestion to buy or sell any specific stock, so please make sure you're always doing your own research and due diligence and sticking to your own investment plan. Thank you guys so much for watching. Have a great day. I'll see you back here next time.